It's a sea of red out there. You've probably seen the panicked headlines, trillions of dollars just vanishing into thin air, seemingly overnight. Right now, global markets are in a total free fall, and it really feels like it happened in the blink of an eye. So what on earth triggered this financial earthquake? Well, in this explainer, we're going to connect the dots and figure out exactly what's behind this massive global sell-off.
Okay, let's start with a number that's, well, it's almost hard to wrap your head around. In the Indian market alone, investors lost a staggering 34 lakh crore rupees, and that's in just 1 month. I mean, to put that into perspective, that is an unbelievable amount of wealth just wiped out in a few weeks. So, what does a loss of that magnitude actually look like?
It looks exactly like this, a complete bloodbath. On just a single day, we saw major indices like the Nifty 50 and the Bank Nifty drop by well over 2%. It didn't matter if you were in large caps or small caps, pretty much no corner of the market was safe from this intense selling pressure. Look, this kind of synchronized crash doesn't just happen. It's a reaction, right? It's fear made visible on trading screens all over the world. So the really crucial question is, what's at the epicenter of this financial earthquake? Let's start peeling back the layers.
Okay, so the primary trigger, the one thing that has markets everywhere completely on edge, is a rapidly escalating conflict in West Asia. And right at the heart of this whole geopolitical storm is Iran, which seems to have been emboldened by its ability to rattle the entire global economy. And this isn't some simple, isolated conflict. The situation is incredibly complex. There are real concerns about rapidly depleted U.S. munitions, which makes you question the sustainability of any long-term engagement. Then you add the potential for Houthi involvement, which could mess up crucial global shipping lanes, and what you have is a geopolitical tinderbox just waiting for a spark.
And then, that tinderbox got a massive spark. Over the weekend, the United States bombed Harg Island in Iran. Now, why is this such a big deal? Because Harg Island isn't just a piece of land. It is a critical energy hub. This single action sent an immediate shockwave right through the global system.
And that brings us to the most immediate consequence. See, when you attack a major energy hub, energy itself becomes a weapon. The conflict's first and most powerful economic shockwave wasn't actually felt in the stock market. It was felt in the oil and gas markets.
An attack on critical infrastructure like this immediately puts the entire world's oil and gas supply at risk. I mean, think about it. Our global economies are built on the assumption of a stable energy flow. The moment that's thrown into question, uncertainty just takes over, and financial markets react instantly, because if there's one thing they hate, it's uncertainty.
And you can see that reaction right here, clear as day. Brent crude oil, which is the benchmark for global prices, surged 3% to nearly $100 a barrel. That is the highest it's been in years. This isn't just a minor blip, it's a huge price shock, and it's rippling through the entire global economy.
And this is where the domino effect truly begins, creating a full-blown crisis. First, Saudi Arabia reportedly cuts its output. Then, U.S. heating oil prices soar. Qatar has to halt its LNG shipments, which has this bizarre side effect of doubling helium prices, of all things. All told, the Gulf states lose an estimated $15 billion in revenue. And now, you've got major banks like Goldman Sachs forecasting that oil is going to stay above $100. It's just a cascade of negative consequences, one right after the other.
So, why does any of this matter to you? Well, because it shows up in things like this. Indigo announced it's introducing a fuel surcharge, and they're citing an over 85% surge in jet fuel prices. That extra fee on your next plane ticket? That is a direct result of the geopolitical tensions we're talking about. This is global economics hitting you right in the wallet.
So with the energy market in total chaos, that fear inevitably spills over into the stock market. And this is where we see what you could call the great investor retreat. In times of high uncertainty, big money doesn't like to take risks. It looks for safety, and that often means pulling capital right out of the markets.
And this slide just visualizes that retreat perfectly. On one side, you have foreign institutional investors, or FIIs, pulling nearly 57,000 crore rupees out of the market in March alone. On the other side, trying to tip the scale back, are the domestic institutional investors, or DIIs, who poured in money to try and stabilize things. It's a real tug-of-war between global fear and local support.
And the result of that tug-of-war? It's just widespread pain. This chart shows the weekly performance, and it is absolutely brutal. I mean, no sector was spared. Look at autos, down over 10%. Both private and public sector banks are down more than 7%. Even IT and realty took some really significant hits. This wasn't a targeted sell-off, it was just indiscriminate.
And of course, these tremors aren't just confined to India.
Over in the US, the S&P 500 closed at its lowest point since November of the previous year. All the major US indices, the Nasdaq, the Dow, the Russell 2000, they all ended the week in the red. And as the new week gets going, Asian markets are already opening weak, spooked by those same high crude prices. It really is a connected global story of fear.
So as we look ahead, what's going to be driving the market's future? Well, it really boils down to two core fears: a twin threat of war and interest rates, and they're creating a perfect storm of uncertainty.
Right, so here's the second part of that threat. All those surging energy prices we just talked about, well, they fuel inflation. And to fight inflation, the US Federal Reserve might just have to keep interest rates higher for longer. The market is already reacting to this. A month ago, the odds of 2 rate cuts were over 30%. Today, they're below 20%. This just adds a whole layer of economic anxiety on top of all the geopolitical fear.
And this headline, it really says it all, doesn't it? War and interest rate decisions to drive markets this week. That's the crucial point right there. These are the two massive forces that investors all around the world are going to be watching: the path to de-escalation in the war and any signals from the central banks on interest rates.
And so, this is the question we're all left with these global tensions simmering, supply chains at risk, and the world's energy supply caught right in the crossfire. How long can the global economy actually withstand this much pressure before something else breaks?